to the Chartered Accountants Worldwide Network USA webinar, What's Happening with International Financial Reporting Standards, presented by BDO. My name is Jeff Aldridge, and I am the president for the Chicago chapter of Chartered Accountants Network USA, and I'm also a corporate tax principal with BDO. Before we start today's webinar, we need to run through a little housekeeping. So first up, a handout is available. You can download this from the control panel for this event. Secondly, if you have requested it, this webinar is CPE eligible. To qualify, you will need to answer the polling questions we will be asking during the webinar. There are 4 polls during the webinar and a survey when you exit. You need to answer at least 3 of the polls to qualify and attend for at least 50 minutes. The format of today's webinar is a 60-minute presentation, including this introduction. If you have any questions during the webinar, please note them down in the Q&A tab in your control panel. We will also be recording the presentation, and we'll make the recording available on the Chartered Accountants Worldwide Network USA website afterward. At the end of the webinar, when you exit and take our short survey, please do let us know what you think. Plus, let us know if you want us to connect you to any of the presenters. Our learning objectives for today are that after the presentation, you should be able to understand modifications of financial liabilities, new standards effective for 2023 and beyond, accounting for hyperinflationary economies, IFRS 18, primary financial statements and the replacement of IAS 1, and netting of assets and liabilities. Discussion of these areas will be followed by a wrap-up session and any audience Q&A. And now let me ask Andrew, who's one of the co-presenters, to put up our first poll. And while you're responding to that, I'd just like to introduce our team as well. As I mentioned earlier, I am a tax services principal at BDO. I focus on helping foreign and/or private equity owned US companies with their tax needs. And before I introduce the first of today's speakers, I just want to say a couple of very brief words about BDO as well. BDO is the 5th largest accounting firm in the world. We offer a full suite of tax assurance and advisory services from more than 60 offices across the US and over 160 countries worldwide. In the US, we are now also a proudly employee-owned business as well. So our presenters today are part of our global services group, specifically within our IFRS team. The team helps clients with conversions to IFRS, specific technical reporting issues and general ongoing reporting, as well as supporting BDO's audit and assurance practice with reviews of IFRS review reports and opinions. They're also well connected with our global IFRS reporting team that has a wealth of resources and brings together our experience from around the world dealing with the practical applications of IFRS, particularly with regard to implementing new standards. So it looks as though the poll is closed. Thank you very much for responding to that. From the team that I was just speaking about, you can see their pictures up on screen now. I'm joined today by Andrew Moore, who's part of, he's a director in our professional practice. I'm also joined by Oscar Ayala Murillo, who is another director in our professional practice. Shane Klassen, who's a senior manager in the same team, and Kishan Kumar, who is an associate director in the same team. So I guess with that, let me hand you over to the first presenter, who is Oscar.
Thank you, Jeff. Appreciate it. Okay, so let's now start discussing modification of financial liabilities and go through a few examples and aspects that we're seeing in practice. Let's start with IFRS 9, and more specifically the paragraph 3.3.2, which provides the requirements that are related to the modification of financial liabilities. Now, IFRS 9 states that a substantial modification of the terms of an existing liability or a part of it shall be accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. So the important question here arises is, when is the modification considered a substantial modification? And we'll be discussing this further as we go through the standard and practical examples. So in order to determine whether the modification is considered a substantial modification, and the next slide, please. We go to IFRS 9, and more specifically paragraph B3.3.6, which provides the requirements to determine whether the terms of the modification are substantially different. So the entity is required to perform a quantitative assessment. And this quantitative assessment is commonly known as the 10% test, which means that the modification will be considered substantial if the present value of the cash flows under the new terms using the original effective interest rate is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability. Now, a key point to note in the quantitative assessment is the effective interest rate to be used for discounted and modified cash flows, which must be the original effective interest rate. And this is to ensure that there is an apple-to-apple comparison. Now, it is also important to note that when performing the computation of the present value of the cash flows under the new terms, an entity is also required to include any fees paid or net of any fees received. And those fees should include only those that are paid or received between the borrower and the lender, and including also fees paid or received by the borrower or the lender on the borrower's behalf. Now, conversely, if the quantitative assessment is that the difference is less than 10%, then the entity also needs to evaluate qualitative factors. Now, with these qualitative factors, if the modified terms are determined to be qualitatively different from the existing ones, then the modification is to be considered to be substantial. And we'll bring this to life as we go through a few examples on factors of the qualitative assessment. Next slide. Now, why is a qualitative assessment required? Now, not all changes in the terms are such that their effect is captured in the quantitative assessment. And as such, it is necessary for us to understand how these changes on the debt could actually alter the risk exposure on the financial instrument. So a few examples of these factors are addition of an equity conversion option, a change in currency, a change in the basis of the interest rate from fixed to a floating or vice versa, and significant extension of the term of the debt. Now, as we go through this assessment, is a high degree of judgment based on the facts and circumstances. So it is important to understand and clearly identify all the terms of the modification. Next slide. So now that we understand the basis for that quantitative and qualitative assessment, the accounting treatment of the modification depends on whether that modification is substantial or non-substantial. As such, a substantial modification is considered an extinguishment of the existing liability and of the existing financial liability, and that liability is derecognized. Now, at the same time, a new financial liability is recognized at fair value. The difference between the carrying amount of the existing liability and the fair value of the new liability is that gain on loss on extinguishment, which is then recognized in profit or loss. And any costs or fees that are incurred in that modification are included as part of the gain on loss on extinguishment. In case of a non-substantial modification, the carrying value of the existing financial liability is adjusted to reflect the present value of those revised cash flows where you use the original effective interest rate. And this adjustment, which is the modification gain or loss, is recognized in profit or loss. Any costs or fees that are incurred as part of that modification are included in the new carrying amount of the modified liability and amortized over the remaining term. And we'll go through a few other examples on a not substantial modification. Next slide. So the scenario here is as follows. Tasty Burgers Limited obtained a loan from the bank for $100 million on the 1st of January of 20X1. The loan is a bullet loan that is repayable after 5 years and carry an interest rate of 7%. Due to financial difficulties, in 20X3, the company approached the bank for a debt restructuring, and the new terms are as follows. It extended by 2 years to 20X7. The interest rate has been revised to 9.75 from 7%. The bank charges $2 million for the restructure, and the company incurs legal fees of $1.5 million. The amortized cost of the loan at the end of 20X3 or at the date of the modification is 97.6 or 97.76, and the original effective interest rate is 8.26. So with these facts, let's go through the exercise. Next slide. So as discussed in our previous slide, when performing the computation of the present value for the cash flows under the new terms, the entity is required to include only those fees that are paid, net or any fees received. So, and those fees should only include those fees that are paid or received between the borrower and the lender. Therefore, only the bank charges of the $2 million are included in the computation of the present value of the revised cash flows. And the 1.5 on legal fees are not included as part of this 10% assessment. So in this example, the company performed a 10% and discounted the present value of the cash flows under the new terms, which is computing the interest payments at 9.75% and discounted the revised cash flow using the original effective rate of 8.26 and extended the loan by 2 years to 20X7. The total present value of the modified lab debt is 106.9, and because the carrying amount of the loan, or better said, the amortized cost of the loan at the end of 20X3 was 97.76, the difference is less than 10%, and therefore the modification is non-substantial. Now, also discussed previously, in the case of a non-substantial modification, the company would also need to evaluate the qualitative factors, and in this case, the company did not note any that will qualitatively lead to a conclusion of that modification to be substantial. Therefore, this is a non-substantial modification. Next slide. Now that we know that the modification was not substantial, then the next step will be to compute or calculate the amount of modification gain or loss. And that modification gain or loss is calculated as a difference between the current value and the revised or adjusted carrying value, considering the 10% less than any fees included in it. And keep in mind that inclusion of fees in the computation to determine that modification gain or loss will result in an upfront recognition of the fees instead of amortizing them over the remaining term of the loan. Next slide. Now, this slide is just a comparison of two tables to show that the cash flows that will be considered for the 10% test and for the calculation of the modifying gain or loss. And as you can see, the difference is the $2 million in fees that were paid to the bank. Next slide. Now that the company has performed a 10% test and the modification gain or loss is accounted for, a revised effective interest rate is required to be calculated. So in order to compute this new effective interest rate, the fee and the cost incurred, both the 10% test and other costs, which equals at $3.5 million, are reduced from the carrying value. And the revised EIR is calculated based on this balance and the modified cash flows, and it comes to 9.31%. Now, as a reminder, the $3.5 million is the total charges that were paid of $2 million for the restructure plus of $1.5 million on legal fees. The table on the right depicts what will be the result of modification gain or loss, considering the present value calculated in the 10% test. And this will result in a lower effective interest rate of 8.71%. So effectively, a higher modification loss or a lower modification gain will be recognized upfront to the extent of the fees, which will then be compensated by a lower effective interest rate. So when computing the revised effective interest rate, please remember that in case of a non-substantial modification, the carrying value of the existing financial liability is adjusted to reflect the present value of the revised cash flows, and then using the original effective interest rate, and any costs or fees that are incurred in that modification are included in the new carrying amount of the modified liability and then amortized over the remaining term. Next slide. And then this table depicts the revised amortization schedule that is based on the revised or new effective interest rate of 9.31%. Next. Now, moving to the sort of fun part of the assessment, which are the journal entries that will need to be recorded for this modification. And the first journal entry will be the recognition of the gain and loss, which is the result of the difference between that carrying value of 97.76 and the 104.90, which is explained on the page 13 of your handout. The modification loss is recognized by debiting the profit or loss and crediting the financial liability. The second journal entry will be to record the payment of the bank charges for 3.5, and the payment of that will be to as debiting financial liability and crediting the cash. And as you can see on the right-hand side of the slide, then the amount of the liability after the modification entries is 101.4, which is the opening balance in the revised amortization schedule that we just saw in the previous slide. Now, once the initial entries are recorded, then the entries to account for the interest and the payout for the subsequent years will be based on the revised amortization schedule, which is on page 15 of your handout. Now, before moving to another aspect of that modification, let's just briefly discuss what if the outcome of this exercise would have been a 10% that will mean a substantial modification. So the difference is that the gain or loss and extinguishment will be calculated the same way. However, it will be the difference between the fair value of the new liability immediately before the modification and the carrying value of the existing liability. Also, a new effective interest rate will be required to be calculated for the new liability. And the journal entries will be the first one that relates to the derecognition of the old financial liability and the recognition of that new liability, the loss on extinguishment, and then also recording the transaction cost. However, the transaction costs for the extinguishment are recorded in profit or loss as part of the gain or loss on extinguishment and not as part of the new financial liability, as you can see here with the modification to be considered non-substantial. So that's the main difference. Next slide. Now, another aspect of the modification of financial liabilities, and something that we see most of the time when there is a modification, is when a portion of the loan is settled. So let's walk through an example. On January 1st, 20X1, Entity A obtained a 100 million loan from Entity B. It is a bullet loan payable or repayable after 5 years with an 8% interest rate. And on December 31st, 20X4, Entity A enters into an agreement for a modification. The modification terms are as follows. Entity A settles the loan in part by repaying 50% of the loan on the 31st of December of 20X4. The interest rate for the remaining 50% of the loan increases to 13%. The term of the loan is extended by 2 years. The present value of the revised remaining cash flows based on the original effective interest rate is 55 million. And at the date of the modification, the amortized cost of the loan is 99 million. Therefore, the amortized cost or portion of the loan remaining, which is 49.5 million, which is 50% of the 99 million. So based on these facts, let's just go through how will the 10% test be performed. Now, although there is no change in the terms for the portion that is settled, the loan did not have a prepayment option, and therefore the revised terms for the remaining portion may also relate to in part to the portion settled. Therefore, the assessment should be performed for the entire loan. Next slide. But now you may be asking yourself, what happens in a reverse situation when a portion of the debt is settled with modification or a prepayment penalty? So, and there is no change in the terms of the portion outstanding. Will that 10% be carried out based on only the portion settled? And now the favorite answer to that question will be, it all depends. And it all depends because the settled portion may contain terms that relate also to the portion that is outstanding. So for example, a prepayment penalty that is payable on a part settlement may also relate to both the settled amount and the outstanding amount. And we'll see an example of determination of unit of assessment when there is no change in terms of the portion outstanding. Next slide. And here's the example. On the 1st of January of 20X1, entity A borrowed 100 million from entity B, cost is 5 million, and the loan is payable after 5 years. There is a floating rate of interest of Euribor plus 100 basis points. The loan does not have a prepayment option. And after 2 years, the interest rates have significantly increased, so entity A has a surplus cash and would like to prepay the loan. There is an agreement with the bank, and the prepayment is agreed as below. Now, entity A prepaid 50 million on January 1st, 20X3. There is a prepayment penalty of 2 million, and the remaining loan balance of 50 million will continue on the original terms. Next slide. So because entity A has a cash surplus, we're assuming that there is no change in entity A's credit standing at the date of the modification. So it will have received a new loan on the date of the modification at the same spread of 150 basis points. Therefore, it's more likely that the prepayment penalty of the 2 million relates only to the portion settled and the unit of assessment may only be that portion that is settled. Now, conversely, let's say that assume that entity A's credit rating has deteriorated on the date of the modification, and it will have received a new loan on the date of modification, but only at a spread of 200 basis points. So here is likely that the prepayment penalty of 2 million relates to the loan to both the portion settled and the portion outstanding. So therefore, that unit of assessment should be the entire loan. Now, this is just a quick example to illustrate the assessment, but it will be noted that there may be other factors that are involved in that credit rating or besides credit rating. Therefore, that determination of the unit of assessment will require judgment. And in practice, there are situations where the appropriate unit of assessment is only a part of the loan, will be fewer than those where the unit of assessment will be the entire loan. Next slide. Now, with the modification of financial liabilities, there is also another aspect that we see frequently, and is when the financial liability is a floating rate instrument. And as such, the question arises as to how that future interest cash flows be determined under the new term of the loan or the original terms of the 10% test. So let's have a look at this case study that deals with this question. And the facts are as follows. On January 1st, 20X1, the company A obtained a loan for 50 million at a floating rate of 6-month Euribor plus 200 basis points. And that rate resets every 6 months on the 1st of January and 1st of July. On the 31st of March, 20X4, due to financial difficulties, company A approaches the bank for a restructuring. And the terms are extended by 2 years. The interest is revised to 6 months Euribor plus 300 basis points. And the 6-month Euribor on various dates is as follows. On the 1st of January, 20x4 is 3%, and on the date of the modification is 3.5%. Next slide. So the question here is, how will the future interest cash flows be determined under the original and revised terms of the loan? And again, our famous answer as accountants, it will be, it depends. And it depends because IFRS 9 does not contain any specific requirements that are related to the determination of cash flows for floating rate instruments. Therefore, it's really up to the entity to choose an accounting policy. And as you can see on this slide, there are only 3 approaches. The first one is method 1, which is on the basis of that 6-month Euribor that resets on the date of the last reset, meaning the 1st of January of 20x4, which will be 3%. The second method is based on the 6-month Euribor on the date of the modification, which is 31 March 20x4, or 3.5%, except for those cash flows on June 30th, 20x4, because of that reset every 6 months. So those will be based on the interest rate that reset on January 1st, 20x4. And then the third method is the 6-month Euribor forward curve, except for those cash flows on June 30th, which also be reset or based on that reset on January 1st, 20x4. So any of the approaches here mentioned may be followed, but so long that the company select, or the method that has been selected is applied consistently by the entity. And with that, I believe we have a polling question. So let's take a few seconds.
Hi, good morning, everyone. My name is Kishan Kumar, and I'm part of Professional Practice Group with BDO as Associate Director. I'll pick up topic for new standards effective for 2023 and beyond. Next slide, please. Thank you. Starting with IFRS 17, that is insurance contracts. This new standard takes the view that insurance contracts combine features of a financial instrument and a service contract, and that these contracts may generate cash flows that vary substantially over time. As such, the standard takes the approach of 1. Combining current measurement of future cash flows with recognizing profit over the period that services are provided under the contract. 2. Presenting insurance service results separately from insurance finance income or expense, and requiring an entity to make an accounting policy choice for each portfolio, whether to recognize all insurance finance income or expense for the reporting period in profit or loss, or to recognize some in other comprehensive income. It's also important to mention that subsequent to the issue of IFRS 17, amendments to the standard and deferral of effective dates have been made. Another standard that's effective is the disclosure of accounting policy, or amendments to IAS 1 and IFRS Practice Statement 2. With respect to the amendment to IAS 1, it requires companies to disclose their material accounting policy information rather than their significant accounting policies. The amendment changes the disclosure requirement with respect to accounting policies from significant accounting policy to material accounting policy information. On the other hand, the amendment to IFRS Practice Statement 2 provides guidance on how to apply the concept of materiality to accounting policy disclosures. One of the main reasons for these amendments are to help companies improve their accounting policy disclosures so that they provide more meaningful information to its investor and other primary user of the financial statements. And it also provides guidance on when an accounting policy information is likely to be considered material. The next standard relates to the definition of accounting estimates. Amendment to IAS 8 accounting policies, that is changing accounting estimates and errors. This amendment has added the definition of accounting estimates, and it also clarifies how companies should distinguish changes in accounting policy from changes in accounting estimates. And as you know, this distinction is important because changes in accounting estimates are applied prospectively only to future transactions and other future events, but changes in accounting policies are generally also applied retrospectively to past transactions and other past events. Next slide, please. Thank you. Now let's move to amendment to IAS 12, that is deferred tax related to assets and liabilities arising from a single transaction. In May 2021, the ISP amended IAS 12 to clarify the scope of the initial recognition exemptions. Though this amendment, it is now clear that the initial recognition exemption doesn't apply to the initial recognition of an asset or liability, which at the time of the transaction gives rise to equal taxable and deductible temporary differences. Example, many leases, asset retirement obligations. The effect of these amendments essentially means that the initial recognition exemption is not available for transactions which involve the recognition of both an asset and a liability, which in turn lead to equal and opposite temporary differences, such that deferred tax are calculated and booked for both temporary differences, both at initial recognition and subsequently. It is important to mention that the amendment applies to transactions that occur on or after the beginning of the earliest comparative period presented. Last but not the least, we have another amendment to IAS 12, and that relates to Pillar 2 model rules. These amendments to the Pillar 2 model rules introduce a mandatory temporary exemptions to the requirement of IAS 12 from recognition and disclosure of information about deferred tax assets and liabilities related to Pillar 2 income taxes. Pillar 2 consists of two main rules to ensure that the large multinational groups, generally with revenue exceeding 750 million euros, pay a minimum amount of taxes on income arising in each jurisdiction in which they operate. The rules are the global anti-base erosion rules and the subjective tax rules. Even though the amendments provide an exception to the recognition and disclosure of the deferred tax assets and liabilities, it also provides for additional disclosure requirements with respect to an entity's exposure to Pillar 2 income taxes. The amendments are effective immediately and retrospectively in accordance with IAS 8, except for some disclosure requirements. If you'd like to know more information about it, BDO has issued two IFR bulletins. The one is 2021-10 and another is 2023-01. And we have the link available here in the slides, and you can access the publications. Next slide, please. Now let's spend some time on the hyperinflationary economics update. Any next slide, please. Okay, moving on to a quick update on hyperinflationary economies. As we delve into this topic, it is crucial to acknowledge that hyperinflation remains a critical concern in various parts of the world, and more so during 2023 and going onwards, as most of economies experiencing an increase in inflation rates. As such, we thought it would be helpful to discuss IAS 29 and what it do if we were to encounter these conditions, not only in financial statement of companies whose functional currencies are those of hyperinflationary economies, but also for consolidated financial statements of groups with foreign operations, example, any subsidiary, associates, or joint arrangements, whose functional currencies are those of hyperinflationary economies. Now, IAS 29 requires financial statements, including any comparative period, to be expressed in units of functional currency as at the end of the applicable reporting period. What this means is that presenting financial information based on historical amounts, even if only a few months old, will not provide relevant information to users of financial statements, as the currency of a hyperinflationary economy loses a significant amount of purchasing power from period to period. And IAS 29 should be applied from the beginning of the reporting period in which the company identifies any hyperinflation. One important thing, please keep in mind that restatement to current units of currency for non-monetary items and items of income and expenditure is made using the changes in a general price index, and the gain or loss on the net monetary position must be included in profit or loss for the period as well as disclosed separately. Companies must also disclose the fact that the financial statements have been restated, the price index used for restatement, and whether the financial statements are prepared on the basis of historical cost or current cost. Also keep in mind that the term hyperinflation is not defined in IAS 29, and it's a matter of judgment. However, IAS 29, more specifically, paragraph 3, provides 5 characteristics of a hyperinflationary economy, which are defined as factors such as prices, interest, and wages linked to a price index, and cumulative inflation over 3 years of around 100% or more. It is important to note that the cumulative inflation rate is based on the IMF publication of the historical and projected inflation data by country. We have included the link to BDO's IFR bulletins, which actually summarizes the application of IAS 29 to jurisdiction, and it is published as of date 31st October 2023. Next slide, please. On this slide, we can see the countries which has been identified and categorized under hyperinflationary market. The list of hyperinflationary economies have continued to evolve due to deteriorating economic conditions and high inflation in several countries. These jurisdictions must apply IAS 29, which results in financial statements, both current and prior comparative periods, being restated to reflect current inflation rates. As you can see on this slide, we have 3 countries who have been added in the list of 2023, and we have almost 7 countries which we are on the watch list for 2024 and onwards, and whose functional currencies are those of hyperinflationary economies. The one on the watch list are Angola, Leo People's Democratic Republic, Liberia, Malawi, Pakistan, Sri Lanka, and Syria. Any next slide, please. With this, we have a polling question here. We have seen in the previous slide the list of countries under the hyperinflation in 2022, 2023, and watch list for 2024. Quick polling question is, a current example of a hyperinflationary economy is Turkey. Is it yes and no? Over to you, Andy.
Okay, so today I'm going to talk a little bit about the new standard that's coming out, so IFRS 18. So in July 2023, the IASB completed its technical work on its primary financial statements project. So the project will conclude with the release of a new IFRS accounting standard, which is going to replace IAS 1, presentation of financial statements. Now, the new IFRS accounting standard will set out significant new requirements for how financial statements are presented, with a particular focus on the statement of profit or loss, including the requirements for mandatory subtotals to be presented, also requirements around aggregation and disaggregation of information, as well as disclosures related to management performance measures. So the standard is expected to be issued by the IASB in April 2024, so it's coming up soon. Okay, so IFRS 9, 15, 16 and 17 had significantly changed the recognition and measurement requirements for financial instruments, revenue, leases and insurance contracts respectively. So however, IFRS 18 is going to significantly change the presentation requirements of IFRS accounting standards. The IASB had received feedback from investors that comparability of entities' statement of profit or loss in particular was reduced due to a lack of consistency in how financial performance was being measured. So for example, 2 entities may have similar operations in a similar industry. They may present the results of their operations differently. And also some entities may use management performance measures of profit that reduce comparability as well. So just thinking about examples of this kind of in more detail. So many entities present operating profit on a statement of profit or loss, but that could be defined differently. And indeed, some entities may not present operating profit at all, as IAS 1 doesn't specify a requirement for that. Another area where you could have quite a big swing in differences is where an entity may present operating profit, including the results of an associate accounted for under the equity method, whereas others may exclude it from operating profit. So again, that really affects comparability a lot. So in response to these concerns, the IASB undertook a project to replace IAS 1 with a new IFRS accounting standard to increase the comparability of financial performance measures presented by entities. So the final text of IFRS 18 isn't available yet, as I mentioned earlier. They're expecting that to be out in April. But this presentation is going to focus on what we understand at the moment based on staff papers and information that's been released to date. So as you can see on the slide, the idea is to retain many of the existing requirements in IAS 1 without significant changes, such as the primary statements that are going to be presented will look the same. So, will be the same. So the statements that are there will be statement of cash flow, statement of income, statement of financial position, in the statement of changes in equity. Also, the requirement for comparative information is going to remain the same. And most of the presentation requirements for financial position, statement of cash flow, and statement of changes in equity are going to remain the same as what IAS 1 currently proposes. Most of the focus is on the P&L. And IFRS 18 also isn't going to change like the fundamental concepts such as assets, liabilities, income and expenses, etc. And so the idea is to build on the base of IAS 1 and bring in some additional guidance to help with comparability. Okay. So one of the largest differences that the new standard is going to introduce is the requirement to categorize income and expenses into one of 5 categories. So we'll just run through them quickly here. So we're going to have an investing category, which is going to be income and expenses related to assets that generate a return individually and independently of the entity's resources. So looking here at things like your return on your cash and cash equivalents, and your return on investments in associates and joint ventures, or a subsidiary if you're presenting a separate set of financial statements. Another category will be financing, which is going to be things like interest expense. And then you're going to have an income tax section, which is going to focus on the areas that are in the scope of IAS 12. Discontinued operations section, which is going to be include the items that are in the scope of IFRS 5. And then finally, kind of a catch-all residual category, which is going to be that operating category. Okay, so once the items of income and expense are classified, the categorization results in line items and subtotals being presented in the statement of profit or loss is going to change, and there's going to be more mandatory requirements under IFRS 18. So at the moment, IAS 1 has limited requirements regarding the line items and subtotals that are presented in the P&L. So revenue is presented as the top line, and that is stated in the standard. And then there's a catch-all like profit line at the bottom, but there's limited guidance about what comes in between. So in addition to the mandatory subtotals and totals required by IAS 1, IFRS 18 is going to introduce 2 new mandatory subtotals. One around operating profit or loss, and the subtotal of all income and expenses classified as operating. That's going to be a requirement now. And that kind of is going to avoid some of the inconsistencies that I mentioned earlier, with some companies presenting it, some companies not. The other one is around profit before financing and income taxes. And so this is going to be the subtotal of operating profit or loss and all income and expenses classified as investing. So again, that's going to be a mandatory requirement going forward. Okay, so IFRS 18 is going to expand the requirement for labelling and aggregation and disaggregation. So in terms of aggregation and disaggregation, there's going to be 2 main changes. First is to require an entity to classify identified assets, liabilities, equity, income and expenses into groups based on shared characteristics, and also to separate those items based on further characteristics. So items should be disaggregated if the resulting disaggregation is material. That's a concept that is there in IAS 1, or some of the kind of the breaking out of material items is certainly there in IAS 1, but there's going to be more clear definitions around that in IFRS 18. So one of the other points is around the use of labelling. So for items previously grouped as other, IFRS 18 is going to require an entity to use the other label only if it's unable to find a more informative label. So for an aggregation of varied material items, the use of other is going to need to be more specific. So for example, in operating expenses, you might have an other operating expenses, or you might have an other finance expenses, just to be a lot more specific in the detail there. And also there's a requirement in IFRS 18 around the presentation and disclosure of expenses classified as operating. So there's more specific guidance in that area. So it's going to be continue to permit the presentation of expenses in the operating category by nature, so salaries, depreciation, etc., or by function, such as administration and selling costs. There's also potentially going to be a mixed presentation of operating expenses by nature and function, depending on the circumstances, and we'll see more guidance as the standard comes out on that. There's also going to be new requirements for entities that classify expenses by function, including the requirement for a single note to disclose expenses by nature for certain amounts. So again, the IS1 does have some of these specific items, but there's going to be more granular requirement around things such as employee benefits, impairments, depreciation and amortization too. Okay. So IFRS 18 is expected to result in certain consequential amendments to other IFRS accounting standards, albeit these aren't yet formally confirmed, but we thought it's worth just pointing out some of these expected differences here. So the first one's going to be, or it is expected to be, the starting point for your cash flow statement. So at the moment, when you're using the indirect method, IS7 allows you to, or requires the use of a profit or loss number, which is the one defined in IS1. So under IFRS 18, the newly mandated subheading of operating profit or loss is going to be used as that starting point for your cash flow. So that will be a difference there in what your cash flow looks like. Also, the classification of interest and dividend cash inflows is going to change. So under IS, or could change depending on your current accounting policy elections. But under IS7, there's an accounting policy choice to present interest and dividend cash inflows as either operating or investing cash flows. Whereas IFRS 18 is going to take away that policy election and require it to be an investing cash flow, except for entities where there's a main business activity of investing, such as a bank or an insurance company. Also, the classification of interest outflows. So IS7 permits an accounting policy choice for those outflows to be in operating or financing cash flows, whereas IFRS 18 is going to require those to be financing cash outflows. Again, with the exception if you're a bank or an insurance company and that's your primary business. And then finally, the classification of dividend outflows. So IS7 permits an accounting policy choice between operating and financing, and IFRS 18 is going to require that those go into financing cash outflows. And let's just touch briefly on this management performance measure issue. So entities may disclose management performance measures outside of financial statements. So for example, in press releases or management discussion and analysis that's publicly available. So, with the idea to communicate management's view of an aspect of an entity's financial performance. So these management performance measures are often based on a total or a subtotal that's required by IFRS accounting standards, with some adjustments made. So for example, you might have your earnings before interest, taxes and depreciation and amortization, so EBITDA, or some kind of adjusted profit number that strips out like goodwill impairment or share-based payments or something of that nature. So IFRS 18 is going to introduce a requirement that certain management performance measures be included in the financial statements with corresponding disclosures. So I suppose the question is which ones are going to be subject to those disclosure requirements? And some of the details obviously still coming out, but essentially what the current understanding is that IFRS 18 disclosure requirements are going to be required when management performance measures have been used in public communications outside of the financial statements, and they're used to communicate to users of financial statements management's view of an aspect of an entity's financial performance. So this is P&L driven again. If it's a balance sheet item, such as a current ratio or even a cash flow, like an adjusted operating cash flow item, that's not in the scope. So I think one thing to point out is that for many private companies, this isn't going to be a factor that's relevant, but if public companies certainly will be. So then just to touch briefly, so for scoped in management performance measures, entities are going to be required to disclose in a single note a description of why the performance measure was communicated, and then a reconciliation from the directly comparable total in the financial statements, and then also to factor in or present the income tax effect and any non-controlling interest effect. So the inclusion of these management performance measures is going to be a significant adjustment for many entities. And so the owner is also going to need to require some focus from an auditor to capture if this information is being published publicly and therefore is in scope. So just quickly, while IFRS 18 is not expected to be effective until 2027, there is going to be a requirement for comparative information to be brought in. And so the changes are so significant it's definitely worth beginning to communicate this with management and those charged with governance, so that those stakeholders are aware of those upcoming changes and how it may affect the financial reporting externally, but also internally, like how you're going to capture some of that information and have processes and controls around that. Okay, and let's just run the final poll of the day. So IFRS 18 is going to require items of income and expense to be classified into one of the categories. So do you agree or disagree with this? Most are in the agree category, and I agree with you guys. Okay, so with that, I'm going to hand over to Shane. Thanks, everyone.
Thanks, Andy. And good day to all of our viewers. My name is Shane Claassen, and today I'm going to be taking you all through a topic where we commonly see mistakes in practice. And so we thought it would be helpful to give you a quick refresher today on netting, or offsetting as it's commonly referred to. I'm just conscious of time, so I might go through these slides a bit quickly, but bear with me. Next slide, Andy. So what is the issue? Well, as you may have surmised from the previous slide, there are instances where it is appropriate to present certain assets and liabilities on a net basis in the balance sheet. And similarly, there are instances where it's appropriate to net off certain expenses against certain revenues for presentation in the income statement. However, netting may not always be appropriate in accordance with IFRS accounting standards, and in many instances, it will not be considered appropriate. Some of the reasons why inappropriate netting can be a significant issue are that it can result in underreporting of liabilities, the underreporting of assets, and in doing so, the underreporting of an entity's exposure to credit risk. So in other words, hiding the fact that an entity is exposed to credit risk by reducing the gross exposure presented on the balance sheet, and also the incorrect calculation of financial covenants and key ratios and metrics, such as debt to equity ratio, gross margin, and so on. Next slide, Andy. So what does IFRS say when it comes to netting? The answer to this lies in IAS 1, paragraph 32, which states that an entity shall not offset assets and liabilities or income and expenses unless required or permitted by an IFRS. In other words, unless you can point to a specific paragraph within IFRS that does allow you to offset, you should assume that you cannot. So IAS 1 then goes on to prescribe some instances where net presentation in the income statement is appropriate. And it sets these out in paragraphs 34 and 35, which we've summarized here into sort of 3 general rules that we see on the slide here. Okay, so the first is where income and expense should be netted in certain transactions that do not generate revenue, but that are incidental to its main revenue generating activities. So for example, if an entity disposes of a non-current asset, they should present that gain or loss arising from this as a single line, rather than presenting the consideration received as an income and carrying amount of the asset separately as an expense. I think we've all seen this one. So another example is where reimbursements may be netted against the related expenditures when they relate to provisions and are reimbursed under a contractual arrangement with a third party. So an example of this is supplier warranty agreements, for example. And the final example is where the standard notes it's appropriate to offset gains and losses from similar transactions. So it's a bit broad, but a very common example of this is foreign exchange gains and losses. So this one I want to speak a bit about, or a bit more about, because in this day and age, most companies will have forex gains and losses throughout the year. And in many cases, those may be netted, but not all. So IAS 1 does emphasize that if any of the transactions are material, any of those forex gains or losses are material, then they should not be netted. So in other words, you can't net something as material against a bunch of things that are immaterial. So for example, an entity has a large number of forex gains and losses that are all similar in nature due to general trading conditions. However, they have one particularly large and material gain on a single transaction. Then in that case, that gain should not be netted against other forex transactions losses, for example. Admittedly, it's probably rare that an entity will have a material forex gain or loss, but it certainly can happen, and we've seen it happen. So I thought it'd be useful to flag that here. Okay, just conscious of time, we have a couple examples on netting of incomes and liabilities on the next couple slides, which I think we'll skip over, Andy. Obviously, they're in the deck, which you can download and read. And we'll skip ahead to slide 47, where I wanted to specifically take a look at an area where we most often come across offsetting errors in practice, which is the netting of financial instruments. So for this, we look to IS 32, paragraph 42, which says the following. Offsetting of financial assets and financial liabilities may only occur when an entity meets both of the following requirements. So first, there needs to be a current and legally enforceable right to offset the recognized amounts. So for example, if you have two contracts which the entity is required to settle individually, then they can't be offset. And the second requirement is that the entity must intend either to settle on a net basis or to realize the asset and settle the liability simultaneously, the emphasis being on intend. So in other words, they may have the right to settle two contracts on a net basis. However, if they do not intend to do so, then this intention should be reflected in the balance sheet by presenting them on a gross basis. So last slide for me is just taking a look at some common problems where we see the misapplication of the offsetting rules. The first one here is offsetting of costs in excess of billing and billing in excess of costs, also referred to as accrued and deferred income. So we most often see this in companies with overtime revenue, like percentage of completion revenue. And I think what often causes this is that these balances are maintained manually in one big spreadsheet, where you're tracking the progress of contracts, for example. And then that'll get recorded in the balance sheet on one GL account, or maybe two, but recorded in the balance sheet on one line. So the key to note here that if you do have revenue over time and you have billing that's not either always in advance or always in arrears, you should probably be aware that unless there's a legally enforceable right and an intention to settle two contracts or multiple contracts on a net basis, then it's not acceptable to offset that cost and excess balance with the billings and excess balance. And these should be presented gross on the balance sheet as an asset and liability, respectively. I'm conscious we're going to go a couple minutes over. Obviously, if any of you need to drop off at exactly noon, that's totally fine. I'm just going to speak about a couple more examples here because I think they are quite relevant. I have here a couple on tax. I've included the references to standards, so I guess maybe you can read those ones, but just be conscious that tax balances with different jurisdictions are separate balances to be considered. So you can't settle a state tax payable owing to California with a state tax receivable from New York. Therefore, if those two numbers are present, if there's a receivable and payable, those can't be offset into one net payable or receivable. Just to consider that. And then we have a couple of very common ones we see, which is debit supply balances within trade payables and credit customer balances within trade receivables. Just one to be conscious of, that often is an area that we see errors arising. And lastly, intercompany receivables and payables with different entities. So this in a big group scenario where there's 20, 30 or more intercompanies, and there's transactions and loans and balances with various different entities. When we're looking at one sub-consolidation or separate financial statements, and that entity has receivables with multiple entities in the group and payables with other entities in the group, those should be aggregated as a payable and receivable and not presented net on the balance sheet. So conscious that was a bit of a whistle-stop tour through netting, but thank you for your attention, and I'll hand you back to Andy to wrap us up.
Great, thanks, Shane. And so we just wanted to just talk or show to you briefly, and you've got it on the slides, but we've got a wealth of IFRS resources available on our global website, and there's links in here to those. So we have in practice guides to talk you through the big standards and also a model for IFRS financial statements too, which you use a lot if you're preparing those financial statements. And there's a couple of slides here on, this is a US GAAP webinar that's available if you're looking for CPE. We've got registration connection links here. There's also an internal audit webcast series available. So I'm going to skip that. I think I could only see one question. It was around whether the modifications, the liability and modification guidance that we were discussing was at the level of the ISB, and it is an ISB. It was ISB guidance that we were referring to there. And then Jeff, I'll hand back to you for the last slide.
Okay, thank you very much, Andy. That is the end of today's training. I want to thank our presenters for the informative discussion and Chartered Accountants Worldwide Network USA for providing the opportunity to present. For anyone not familiar with Chartered Accountants Worldwide Network USA, we are a non-profit organization dedicated to supporting chartered accountants who reside in North America. Our mission is to facilitate the professional success of our members, provide networking opportunities, and offer training such as today's presentation. If you have any questions regarding Chartered Accountants Worldwide Network USA or suggestions for future trainings or events, please contact your local chapter president or our executive director, David Powell. Also, if you are a chartered accountant and you're not currently a member, please can you sign up on our website and join our group on LinkedIn. Looking forward, our next webinar will be a joint CAW Network USA and Chartered Accountants Australia and New Zealand one in April, called Beyond Accounting Sustainability in Transactions. Finally, in relation to training, please remember to check out our website's e-learning portal, which includes an online ICEX prep class, as well as AICPA CPE courses. That is the end of today's webinar. Thank you everyone for joining. You now may exit today's webinar.